Cramer. Welcome to a special West Coast edition of Bad Money. Welcome to Cramerica from One Market in San Francisco. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but put it all in context. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. The market gets so angry over nothing. It's just plain irritable and very hard to please, like a 3-year-old child. But when you make it happy, the inner child giggles and your stocks will soar. Not that you can tell from the averages today. I was hoping that things would be a little more, say, tame and, yes, even logical, so I could spend some time with you about what happens when artificial intelligence meets healthcare. Last night we went to hear NVIDIA CEO Jensen Huang and Dave Ricks from Eli Lilly talk about AI and drug development. They've opened this facility out here that will apply accelerated computing and generative AI with the work of Lilly scientists to speed up the creation of critical new drugs. But somehow Wall Street treats that monumental effort like it's just a gigantic sideshow. Sell. Instead, we had a confluence of earnings news. The earnings season started today, along with softer inflation, courtesy of a decent consumer price index figure that came out this morning, and an insane new love for retail. Let's start with the market's temper tantrum, though. It's kind of cogent. JP Morgan is the world's biggest bank. We all know that. But CEO Jamie Dimon, cautious guy, and whenever the bank reports, he tends to say things that the market doesn't want to hear. And that's what happened 3 months ago when he talked about cockroaches in the credit market. He sent the stock into a one-day nosedive that crushed the bank's supporters. This time, JP Morgan actually reported a weaker than expected quarter. Not enough underwriting. And the stock eventually got hammered again. Worse, Jamie was back urging caution and getting tough about the right to charge high fees for credit cards to make up for losses. That combination created a tsunami of selling. We saw the same thing last time. I say wait a day or two, just like last time, so you can gradually buy this one weakness. Why? Because it will always bounce back. How do I know that? Because it always has. What else? The markets decided that if you make software, artificial intelligence will make your business obsolete. And that's why Salesforce, Adobe, and ServiceNow were all slammed again today. I mean, laid to waste. Meanwhile, the hardware that powers AI soared, led by once lowly worm Intel and AMD, although the market still won't show any love to NVIDIA. Most fascinating development today, the smothering affection for retail. I can't believe how quickly these stocks have become beloved after being hated for a year. Buyers can't seem to find a level to walk away from when it comes to the dollar stores and the discounters. Being a Dollar General, mine's a good one. I don't get it. Stocks aren't supposed to levitate like this. The wave of buying includes Walmart, of course, and holy cow, Target, with that 4% yield. And a new CEO. Suddenly, Cramer fave Home Depot, the despot, has actual buyers, and Lowe's flirts with new highs. Wayfair won't quit. What's that? Neither will the flawless Ralph Lauren. What gives? I think the inevitable result of what happens when you have tame inflation, which is what we got from the CPI number this morning. The buyers cannot resist anything that benefits from lower interest rates that come from tame inflation. Even if oil's rallying off a geopolitical news flow, we're ignoring that one. Hey, you want hate? I'll give you hate. All you have to do is declare you're going for clean energy to power your data centers. If Microsoft and Meta platforms were to abandon their dislike of fossil fuels and go all in, say, on despise clean coal, or at least cleaner natural gas, they could actually lift their heads and not have them blown off. Without cheap energy, though, what really matters is that Alphabet increasingly looks like the only winner in AI for the moment, and it's partnered with Apple to power Siri and who knows what else. Winner! Of course, this is all day-to-day stuff that could be rolled back tomorrow. So why don't we just take one moment and talk about the big picture? We're still at the beginning of the year. We have these, what I call jailbreaks going on. Happens every year. There's a jailbreak in retail, jailbreak in oil, and a jailbreak in transports. Way too much love for those. But let me tell you where you're not getting the love. Out here in San Francisco. Man, open the Golden Gate already. What the heck? This JP Morgan healthcare conference that I spent the last 2 days, I've seen the guts of pharma, the big healthcare companies, and I think they may all be undervalued here. Irony of ironies, by the way, Johnson & Johnson led the pack, and it was only one of a handful of drug companies that didn't present. I heard things from the likes of Cardinal Health, Amgen, Novartis, Bausch & Lomb, and Eli Lilly that were so perfect for this environment of lower interest rates that I cannot, or lower inflation and lower interest rates, that I can't believe their stocks didn't roar. They should be. More on that one later. As I said at the beginning of the year, though, the first 2 weeks are always a jumbled amalgam of love and hate, too much of both. But the bottom line, now that earnings season has started, the rehearsals are over. And we're going to begin to see the reaction to actual numbers. And if it's anything like J.P. Morgan, what can I say? It's showtime. Let's start with Bob in New Jersey. Bob!
Hey, Jim. Thank you for accepting my call, and thank you for a great show.
Oh, thank you, Bob. That's kind of you.
Well, I've been following you a long time. Now I got a question for you. Hopefully you can help me. I have Siri. I got about almost 400 shares of Siri, and I'm down 50% now. But I've had it a long time, and off and on I've made money with them. But right now I'm down 50%, and I'd like to know, should I keep
listen, we got that the wife, yeah. Hey, listen, we got a 5% yield, okay? And it can bounce back. Is it my favorite? No. Why? Because I like growth, and it doesn't have growth, and that's the real problem. All right, look, the first couple of weeks are very hard to decipher, but now that earnings season has arrived, it's showtime, and we'll get a better sense of where we're actually headed and all this curious amalgam that we put to bed. Well, maybe tonight, we have an action-packed lineup ahead for our second day at the J.P. Morgan Healthcare Conference. I sat down with some of the top leaders in the healthcare industry. Conversation with Novartis, Amgen, Regeneron, that too, and Cardinal Health. So don't go anywhere. And, of course, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Very few drug stocks spent most of last year steadily marching higher, but Novartis is one of them. The Swiss pharmaceutical giant rallied more than 40% in 2025, fueled by some of the strongest sales growth in the industry. But can they keep up this in the face of some major patent expirations? Let's check in with Dr. Vas Narasimhan. He's the CEO of Novartis to find out. Vas, welcome back to Mad Money.
Great to see you, Jim. Thanks for
I've been following your work. I remember when you came here and you put a stake in the ground. You said you're going to be able to get your PE multiple by getting higher, by getting rid of some companies that will be good, create some value. You delivered on everything and more. And by the time, I want people to know, most people thought it was impossible. How did you do it?
Look, Jim, I think over that 8-year period, we've made some bold bets. I mean, what we did is we exited Sandoz and Alcon. Those two businesses as standalone businesses have over $80 billion of market cap. And along the way, we drove up Novartis's market cap by another $80 billion. So we really have been able to unlock over $160 billion of value by becoming a pure play. And I think it was all about betting on our innovation power. It was believing in our science, believing that what Novartis is at its core is a biopharmaceutical powerhouse. And that's really coming through now.
Well, there's an oddity here. You're a real doctor. You also have public health experience. Those are things that would make it so that you would have great science. But you approach this business the way other business people approach. You actually are willing to make a projection into the 2030s because you run this by cash flow. It's incredible.
Yeah. I mean, I think when we look out, I mean, it's all about these medicines that we create. And I think one of the things that comes with being a physician scientist is I can go deep on the science. And what we've been able to do is really bet on novel technology platforms like RNA therapeutics and radioligand therapy. And what that allows us to do is build a portfolio now where we have, 15 inline blockbusters. We have 9 medicines that have multi-billion-dollar potential, another 8 coming along the way. So that portfolio gives us the confidence to call that 5 to 6% growth out to 2030.
I also have to mention your gross margins are well ahead of the rest of the industry. Is that R&D being more targeted? Is it a tight ship? How are you able to do it?
Well, I'm a cost hawk, too, despite being a doctor.
But you're on boss. You cost hawk, but you're also on boss?
We're also on boss.
How's that possible?
Yeah, so I think what we do is we set a high bar. What we say is we're a high support, high challenge culture. We want to set a high bar, challenge people, and then provide the support. I have an unbelievable operations team. Those are the unsung heroes. I mean, they've been able to drive over my tenure over 1,100 basis points of margin expansion. And that's just ruthless being on top of the operations, being on top of the manufacturing costs, and that's what comes through.
All right, so how are you able to tackle things like neuro? Everyone knows you don't go there. The most recent acquisition you made, that has been a doomed technology for everybody, a graveyard. Why do you take it on?
Look, I think these are diseases that have no standard of care. And these patients really suffer. And I think when we saw these technologies like the one with our proposed acquisition of Avidity, very unique science. And what it allows us to do is take RNAs and traffic them to the muscle, traffic them into the nervous system to tackle some of these diseases. And what's really cool about it is we really understand the biology. We know what we need to tackle. The hard part is getting the drug to the right place. And we think we can solve that with this technology. We've actually made now 4 acquisitions now in neuromuscular disease. And I always think to myself, we got to do things that are unique, something different. Obesity, a lot of companies are chasing obesity, well served. But what about all of these other patients that need solutions? And that's where we want to focus our energy.
Okay, I can't help. The first time I learned of you was I was sending my daughter to college just when there was H1N1, swine flu, vaccine. And your old life, you don't have vaccines now. Good, because that's a tough business. But you talked about on the Hill what it took, how hard it is. Surprised that the head of the HHS doesn't seem to share your affinity for life-saving vaccines?
Look, I think right now we're at a critical moment. I mean, I think vaccines have been truly one of the most important human inventions in our history. And you look at the last 100 years, the fact that childhood mortality is where it is, the fact that we can live in the world that we have is in no small part because of vaccines. And I think we have to just keep reminding the public that vaccines are safe. Vaccines are remarkable public health tools, and that we need children to get vaccinated. And that's certainly what I'm all about whenever I talk about the topic.
Now, also, you were adamant that, and you said it in a Q&A, most favored nation rule would be devastating to the industry, talking about the notion of what the president's trying to do. And yet you were able to go with it, and it didn't hurt your numbers. How is that possible?
Look, I think the administration was very pragmatic. I mean, they actually came with an agreement that I think made sense. And what it really allows us to do to go to countries around the world that do not properly value innovation. Because I think the core of this, and where the administration is absolutely right, the U.S. is who is underpinning innovation in our sector. I mean, they're the ones funding the R&D, the U.S. government, U.S. taxpayers, and we need to change that. So what this agreement gives us the opportunity to do is go to these other G7 countries and say, look, you got to pay your fair share or we're not going to be able to launch. So this is a very interesting moment for our sector. I think in the next few years, either of those countries are going to rise to the challenge, or there'll be fewer drug launches in Europe. And I think that's going to be a really interesting, I think, to see how it unfolds.
So it was a more sophisticated thing than just, listen, we're going to cram down drug. That was not the nature of what ultimately happened.
I think this is pretty thoughtful. I think I think there was a long-term policy goal, and I think that's what we now have to hopefully make happen.
All right, I want to talk about some of the things that you're doing that I think are not getting enough credit. Radioligand. I mean, this is really incredible. We're talking about a way to make it so that the patient is able to be targeted and not be blown away. You were really interested in taking further cancer research than anybody I know.
I mean, this is something I'm really excited about.
Yeah, it's yours.
We made this bet 6 years ago. We've really done a ton of work to make it happen, actually even now 7 years ago. And we've actually made it pretty mainstream. There's over 700 clinics in the United States that are providing radioligand therapy. We have 19 projects in the clinic to bring the next wave. And just for the viewers, I mean, this is remarkable technology. We can bring a radioactive particle to a cancer cell rather than radiating the body and kill the cancer cell in a very surgical way. And it ends up being very safe. So we've got prostate cancer, we've got neuroendocrine tumors, now we're working on a whole set of other cancers. And we're the global leader. We have global scale. We have the ability to provide these therapies on time in 3 to 5 days. Because this is radioactive. We have to make the drug and deliver it in 3 to 5 days.
I don't know how you can do it. The half-life is ridiculous. But you're incredible at logistics too, Vas.
Yeah, we've learned this over the years, and I think that gives us a big competitive advantage.
All right, one last question. You have been very forward about the notion that AI is just something in the toolkit. Can you please find anything about earnings per share that AI has really helped? Maybe on chronic highs, maybe that it's helped there because it's something new. Just give me something that says, you know what, AI is saving us money right now.
AI has certainly helped us enroll some of our studies more quickly.
It has.
I mean, I think so. What we can do is we can use AI right now to optimize which clinical trial sites we're going to put our clinical trials in, and it makes things happen more quickly. I do believe in drug discovery in a 5 to 10 year view. This is going to be transformative. But I think the hype cycle is making people too impatient. I mean, we have 10 to 15 years to get a drug from when we discover a target to actually get it to approval. This is a long process. If I got that down to 10 to 12 years, I would be thrilled. 15 to 10 to 12, amazing. But that's going to take time, and you're not going to see that, in the short term.
Well, I hope you get enough credit for the stock's been good for. You've had multiple patent cliffs and you can't see them, and so therefore people at home have a company with a stock that goes up over time because it's just like a real company that we've seen that's secular growth. Most of them are episodic. But because of what you've done, it's not. It's just secular. Congratulations.
Thank you, Jim. I really appreciate all the support.
That's Dr. Vasner, Simmons, CEO of Novartis, and this is just some stock because we got some guy running the darn thing. Thank you.
Thank you very much.
Coming up, will Amgen be the next major player to enter the weight loss drug market? Cramer's getting the latest on where things stand from the company's CEO. Next.
We got some new data from Amgen on MariTide, their late-stage, once-a-month GLP-1 weight loss injection. Now, Wall Street didn't react to the news, but this is a big biotech that's been able to pull off some major drug launches in recent years. So let's take a close look at Bob Bradway. He's the chairman and CEO of Amgen. You get a better sense of what's going on here. Mr. Bradway, welcome back to Mad Money.
Thank you, Jim. Glad to be with you.
All right. Now, first, we just got to address what people have been saying about your GLP-1 versus what the truth is. And the truth is it's entirely possible that maybe you could get to once a quarter. It's entirely possible that you can stop it and still lose weight. You are doing different things from Lilly, and I want things, put it in context.
Well, this is the first long-acting medicine for obesity and obesity-related conditions and potentially type 2 diabetes. So we have a drug that we're studying as a once-monthly injection. We've said that we expect it can be used monthly or less frequently. We've shown what it looks like when it's used every 8 weeks, and we shared yesterday that we're very encouraged about the data for when it's used quarterly as well. And so we think there are a bunch of ways to win for patients when it comes to MariTide and maintaining weight loss, and we think we can address one of the reasons that the field is struggling a little bit, which is the patient persistence issue.
Right, meaning they drop off. They
drop off.
And there's you've got 2-year maintained weight loss. This is an industry publication, just came out after your presentation. I mean, that would be rather remarkable.
Yeah, so we have studied now over 104 weeks, again, across a range of different doses to better understand what we think the appropriate way is to maintain weight loss. So we know that we can induce a very impressive weight loss over the first 52 weeks. And we're going to study that right through 72 weeks. And then we want to understand how do we help people maintain that weight loss over the long term. And we want to understand what will it take for patients to stay on this therapy. Because persistence is the name of the game. The benefit comes from being on therapy.
Yeah, like no one's willing to seem to say it, but the current drugs, 13 months, and that's it. Then people are done. And it doesn't work like that.
And the drugs provide tremendous benefit, but only when the patients are on the drugs.
Right.
And so, again, we think MariTide has the potential to be the first long-acting medicine addressing the needs of patients living with obesity or overweight.
But I do want to point out, I mean, you've got so much going on. You've got a lot of drugs. You made an acquisition, by the way, that, I champion Horizon because I just said they had great stuff, but they didn't have the scale. You have basically blown out what I thought were going to be orphan drugs. Actually, they're going to be drugs for many people.
Yeah. Well, our rare disease business is performing very well. Over the course of the last year, we were annualizing at north of $5 billion, growing at double-digit growth rates. And we're very excited about what we think we can do. But no one was
thinking that could be that. You know that when you were bought, people thought you paid too much money because no one thought that these would ever altogether add up to that much.
Well, the acquisition's working very well for us, and partly because it plays to our strengths, biologics and autoimmunity. So the medicines we acquired address autoimmune conditions and are largely biologics and are at an early stage of their life cycle. And so we're continuing to explore ways and new diseases that might benefit from these treatments. And so far, so good. We're very encouraged by what we've seen.
Now, I want to talk about one of the most important drugs ever, or it should be, Repatha. I take it. Why do I take it? because my doctors at NYU said, look, you want to cut the risk of stroke, you want to cut the risk of a cardiac event, you have to be on it. We insist on it. At first I said, no, it's too expensive. But you put down the cost of it so low, maybe everyone should be taking it.
Well, we've lowered the list price of Repatha twice. Repatha is a medicine that profoundly lowers LDL cholesterol. LDL is the bad cholesterol. So we profoundly lower LDL, and in doing that, profoundly reduce the risk of heart attack or stroke. So, for example, a few weeks ago, we demonstrated that in people who'd never had a heart attack, if we put them on Repatha on top of what was considered optimized therapy, we were able to further reduce the risk of heart attack, in fact, by 36% for people in this study. So Repatha has helped characterize the benefit of bringing the bad cholesterol down to levels that previously weren't achievable with medicines that were otherwise available in the marketplace.
Now, isn't it true that there is no level that's too low for bad cholesterol?
Well, when it comes to LDL cholesterol, Jim, lower is better. And
right.
The data have shown over and over again that lower is better. The sooner you get lower, the better. And some would tell you lowest is best.
Okay. Now, my doctors also said, look, if you want to have any shot at avoiding Alzheimer's, the only thing that's on the market is Repatha. Now, it's not meant for that, but who knows? I mean, why would they give it to me?
Well, we've studied Repatha in the setting of heart disease, Jim. So we've shown that we can prevent heart attacks, we can prevent strokes, we can prevent what are called major adverse cardiac events with Repatha by lowering LDL. We can protect the heart, we can protect the vascular system against these catastrophic things like strokes and
how do we
heart attacks.
get the word out? Sometimes I feel that there's these drugs that are remarkable about, which is, look, it's every other week, it's a refrigerated shot, no one even, you barely notice it. And yet I find that only some of the major healthcare centers, major hospitals seem to know the benefit and then insist that all their patients be on it.
Yeah, well, we need Jim to continue to educate patients, prescribers, and payers about the benefits of Repatha and the importance of lowering LDL to reduce these heart attacks and stroke. Heart attacks and stroke are the biggest cause of mortality in the United States, in fact, all around the world. And the largest contributor to that is that people are walking around with their LDL levels too high. And as you point out, nobody in the United States will pay more than $8 a day for access to Repatha. Most patients are paying a small fraction of that amount. And for the benefit that provides in terms of the reduced risk of heart attack and stroke, we need to get the word out.
It's possible that could be one of the biggest drugs of all time when the word comes out.
Well, I don't know about that, Jim, but it's an important medicine.
I think it will be. One of the reasons why I like the stock so much is the mosaic that you have of things that are just consistent. There's no patent cliff I'd be worried about. And at the same time, some of these drugs that are 3, 4, 5 billion, I think could be 6, 8, 20 billion.
Well, Repatha grew very well in 2025, and we think it will continue to grow nicely through the rest of the decade. And again, it's growing off the back of data which demonstrate that we can prevent these heart attacks and strokes.
Well, I hope people learn, and not just because of the shareholders who's experienced a 3% yield good growth, but this is a remarkable drug, one of many that you have, and it's just that people don't know about it. We got to change that.
Thank you.
Okay, that's Bob Bradway, Chairman and CEO of Amgen, a terrific stock with a great yield. Yeah, money's back.
Coming up, after a late resurgence in 2025, is Regeneron ready to take off in 2026? Cramer's finding out their game plan with the CEO. Next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show.
My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
Last year was a tough one for healthcare, but many of these stocks bottomed as 2025 went on. Look at Regeneron, the colossal biotech that's up about 60% from its lows last summer. So can this thing keep running? While we're here at JP Morgan Healthcare Conference, let's take a closer look with Dr. Len Schleifer. He's the co-founder, co-chair, president, and CEO, as well as being one of our first guests on the show. Dr. Schleifer, welcome back to Mad Money. All right, I'm going to start with something that is very congratulatory to you. Len, what is it like to be the longest serving CEO in America?
Well, I think I'm the second, but...
Well, Warren Buffett retired.
Yeah, but
I did the work. You're number one.
Listen, longevity always isn't a prize, but I'm enjoying what I do.
Okay, so you have developed what I regard as a three-legged stool of just remarkable drugs, and I want to start with Dupixent, which is a drug that is moving the stock, and I want people to know why. Why is this so big?
Well, it's funny. About 10, 12 years ago when we were at this conference, we actually predicted that Dupixent would be a pipeline in a product. We kind of coined that phrase, or at least we're the only ones who actually delivered on that. And what's remarkable about Dupixent is that it's approved for 8 different indications, and it's the leading drug in 7 of those 8. It's used by over 1 million people around the world. It's a very safe product. It's a very effective product. It's been the leader in so many different areas, and people, dermatologists, allergists, pulmonologists, gastroenterologists, ENT doctors, they all touching the drug and find it's making a huge difference for their patients. And that's ultimately what makes a great drug. It's got to work, it's got to be safe, and the doctors have to believe in it.
Okay, so Eylea, I thought the people stopped talking about when they did the biosimilar over at Amgen. You came on a long time ago and said, look, we're going to take over the world. You have to inject your eye 12 times a year. And I said, well, that's awful. The other guys, though, were doing it 52 times a year. Now we're back with a whole new set of reasons to take Eylea HD, and it's working.
Yeah, HD seems to be the most durable product in the field of anti-VEGF therapy for these blinding retinal diseases. And I think it's being well accepted. It's now run rate. It's about $2 billion a year run rate. It's nearly half of our entire franchise. And so the doctors are enjoying it because it's making a difference to their patients being able to go to longer intervals between injections.
Well, everybody wants that. No one wants to.
You know, you mentioned, Jim, that we were talking about in the early days what we were going to do. We were trying to talk about this when we first came on your show.
Right.
When we were nobody, and you had us.
Well, the stock was at 5.
Yes.
It was good buy. Absolutely.
I think it's one of your better calls.
Well, you certainly helped make it one. Libtayo. This is a drug that I think we're all going to hear a lot more about because non-melanoma skin cancer is just, unfortunately, raging.
Right. So your viewers don't get confused. We're still talking about skin cancer. Right. We're talking about those little basal cells or those cutaneous squamous cells that the doctor can knock off. But sometimes they grow in and they're really problematic. And we've had remarkable results there. Interestingly enough, it just shows our technology and our products are different. Where Keytruda, which was the leading IO drug, did a trial there, they came up with a big fat goose egg in an adjuvant study there, and we showed a dramatic improvement, 68% lowering of the risk of this cancer coming back. So it's really important.
All right, so you spoke with George, who is your partner, Ian Copples, who's an amazing scientist, last night. I think you broke a lot of taboos. And one of them I thought was really incredible was you said that AI has limits. I thought that AI was limitless. But you're being a little more realistic about AI.
Yeah, I think George probably said it best. It's not that we don't believe in AI. We do believe that AI can do certain things. But AI isn't going to invent the drugs. AI isn't going to think about how you apply the technology. There are certain tasks that AI can do. We have millions of sequences of people, and they're linked to their anonymized medical records. AI can go through that and find associations much more efficiently than you or I can. Right. But AI is not going to invent the antibodies that we already know how to invent and develop and move forward. It's just not going to do it. And if people think that that's going to do it, I hope they believe that because it just gives us a bigger competitive edge.
It is true, I think, that the next generation chips are able to reason. But could you ask a computer, please solve ALS for us?
No. Look, the AI is as good as the data it can train on. People try and make antibodies with AI. You know what they do? They go to George and say, George, can we have your antibody group? Because we want to train. And we've already trained all of us on this, and our mice know how to do this, and our technology is there. So AI can do certain things, but it's not going to magically say, can you come up with a better show than Mad Money? Well, maybe it could do that. I don't know.
I think
you got more to worry about AI than we do.
You also, there's another symbol. This is one of these conferences where all these big companies are getting their pipeline by buying small companies. You don't believe in that. You also have data which says it doesn't work.
Yeah. Look, there's 2 ways that you can get products. And by the way, getting products is really, really hard. I should add probably 3 or 4 more wheelies there. You can source them from your own labs, or you can try and buy them from other people. Very few people can source them from their own labs. We've got about, I think we're up to 14 drugs out of our labs that have been approved. It's sort of a record, and we can source from our own labs. But it's not that we won't source outside. It's just that when you look at the data, the return on the investment is just not there. Either the drugs fail that you buy because you're buying a pig in a poke, or the bankers are so good, they get the price up so high. We've been involved in some of these auctions where we might think something's worth $1 and somebody else is willing to pay $8.
Well, that's desperation on their part.
Yeah, and that's destruction of value. We're trying to create value,
but
not
let me
destroy
one last question. Out here, everyone claims that they have a drug that could topple Eli Lilly's dominance at GLP-1. You actually have a combination that I think a lot of people would want because it has to do with cholesterol.
Yeah.
And cholesterol is much more of a killer than people realize.
Well, the number one cause of death in the country is still heart disease, and high cholesterol is the main driver of that problem. If you look at what the obesity drugs can do, they actually do lower cardiovascular risk and death, and they're amazing drugs, and Lilly and Novo, they've done great jobs. But if you look at, do they lower cholesterol, the bad cholesterol? Minimally. Maybe it's 10%. I don't even think it's that much. Our drug, Praluent, can lower it by 50% or 60%. Really change the risk. Imagine if you could put that together and you GLP. It's a game changer.
Yeah.
You know why? Because half the people who are obese, they also have elevated LDL. So they need something, in addition to losing weight, they need something to drive their LDL down. I think it's a perfect marriage of 2 great opportunities.
I think it'll be one of the most prescribed drugs in history. I want to thank Len Schleber, the founder, CEO of Regeneron, and I will say it, a friend of our show.
Absolutely.
I appreciate it.
Very good friend.
Good time.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Of course, everybody's right. Let me see the stock title about buy, sell, still just because of the core stock. Right, my step is the great. Play this out. And then the lightning round is over. Are you ready? Ski daddy from the lightning round. But so with Ron in South Carolina. Ron.
Hey, Jim. Good afternoon. I was perusing the stock market recently, and on the NASDAQ exchange, something caught my eye. It's a company called NewTek One.
Yeah, that's a strange bank that I do not know with a high yield. So here's what we're going to do, Ron. We're going to do some work on it because I love a situation that has a big yield and is at a high, and we will come back. Let's go to Donna in Michigan. Donna.
Hi, Jim. I would like to know, I'm up 32% on Texas Instruments. Is it time to hold or is it time to sell?
No, you want to hold it. Why? Because every one of these other semiconductors has ignited. This one hasn't yet. It'll come around. It's been a cyclical rotation. I like the story. Bob in Connecticut. Bob.
Hey, booyah, Jim. Calling on Crane Company.
52-week high. Why not? Diversified manufacturer. It's like what people want are diversified manufacturers that not necessarily are part of the data center right now, and that includes Crane. Good company. Let's go to Bruce in Illinois. Bruce.
Professor Cramer, should I buy more, hold, or sell my position in Catalyst Pharmaceuticals?
I like Catalyst Pharmaceuticals. It actually has, by the way, real earnings, and it's a very inexpensive stock. I think you got a winner. Sam in Pennsylvania. Sam.
Jim, look, I got an interesting one. I'm talking today about GPR. The company has got an interesting small molecule GLP-1. It's a glenprion. It's hard to pronounce. But anyway, it's interesting because it's competitive with the recent one coming out of Novo Nordisk. Given the small molecule nature of this drug means that it has a really low side effect profile. So the tolerability for this new oral GLP-1 coming from GPCR.
And the stock is?
GPCR.
Oh, okay. So this is they have a deal with Roche, and therefore I think it's a legitimate idea. But boy, the stock fully reflects that deal. I don't want to touch it. Lilly is still the gold standard, and that, ladies and gentlemen, conclusion of the lightning round.
The lightning round is sponsored by Charles Schwab. Coming up, Cramer is talking to the CEO of Cardinal Health about how the drug distributor is planning to replicate its soaring growth from last year. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
You get a little rest, all right? You get a little rest.
Well,
it's fine. We'll be fine tomorrow.
The Briones don't hold up, David. When I go right from the airport to here, you notice the Briones are wrinkled. That's
even with your 150 count? Yeah, that's sad.
I do notice that. It's a problem.
Carl,
Go
I'm
get
up
some
to
sleep.
200 now. I went to Milan.
Oh, you got that written into the contract.
It all starts at 9 a.m. Eastern.
Everybody in Washington wants to bash the drug distributors because middlemen get a bad rap in the country, but it never stops them from making fortunes for their shareholders. Look at Cardinal Health, up 74% last year, and surging again today after the company raised its full-year forecast this morning. How did they do it? Perhaps they're not middlemen. Let's dig deep with Jason Hollers, the CEO of Cardinal Health. Mr. Holler, welcome back to Mad Money.
Thanks, Jim. Great to be here.
All right, Jason, a couple years ago, you came on my show. And you said, look, we're going to be additive to the system. Our margins are going to go up, and people are going to say we saved the system money. You did every bit of it.
We did.
How did you do it? Because I didn't think it was possible.
Well, first and foremost, we focused on our core. We simplified what we did. We exited some businesses. We exited some countries. We sold off some businesses. Then we acquired some faster growing, more specialized areas in the specialty space. So we really pruned the portfolio and really focused not only what's best for the business, but these are also areas that we're creating more value for our customers. Because we understand that the pressure that they're under, and we're always looking for ways to improve both our financials as well as their costs.
Now, you've got a method. Let's just talk about the diabetes distribution announcement today. As typical of what you do and how it's anti-friction in the system.
Mm-hmm. That's right. This is a great example of win-win for our customers. In the pharmacy space, these pharmacies are dealing with all sorts of different indications for their patients. They're also dealing with all the different payers. So this program specifically, the Continued Care Pathway program, is to allow those pharmacies to pass on their Medicare Part B work, which is more complicated for them to administer. That's what we do. We can manage all payers for diabetes products, especially CGMs, which is, goes hand in hand with GLPs right now. And it's a great business for them. And they want to keep our customers, the pharmacies, want to keep those patients, even though they can't administer all the different products that they would like to.
Well, I want to go into something that I know that people are going to say their eyes will roll over. I don't care. Management services organizations. These are doctors basically in business. They run this, but they're not necessarily sophisticated about how to run a business. We don't even want them to be, right?
Well, they don't want to be is the main point. I think they want to take care of patients. They want to focus on the clinical side. And so they have a variety of needs to run the business side. When you think about if you're a physician, you need to negotiate with the payers, the insurance companies. You need to hire other physicians. You need to manage the back office. We take care of all that in addition to distribution. And we also help them manage with greater value their data and technology. Our first acquisition in specialty was actually in the data side, and that allows them to monetize that and work with the manufacturers and innovators to not only help provide better service and care to their patients, but also to help the manufacturers know what the emerging trends are looking like.
Okay, let's just use the economics of oral GLP-1s and your knowledge to give us, because it's well known. It's not necessarily what I think of as Cardinal Health, but maybe I should be.
Well, we distribute any and all products. So whether it's the injectables, the orals, all branded, all specialty, all generics. What makes our model unique and why we create so much value for the industry is we literally work with thousands and thousands of manufacturers. Every innovator that's out there, we have some relationship with. And then we deliver those products to tens of thousands of different locations. So GLPs are, in some ways are just another product, but they're a very important product to our customers and patients. And so we prioritize that. But we will make sure that every one of those products gets to our customers and their patients.
You're willing to tackle things that other people have failed at-home solutions. How are you able to do it?
Well, first and foremost, just like the rest of our business, we focused on our core distribution. We have made significant investments in our capacity and in our capabilities in that business. 11 distribution centers throughout the United States, which means we can get to most homes within a day for direct shipments into patients' homes. 3 of those 11 DCs are brand new in the last 18, 24 months. Latest in automation technology.
These are facilities that you've built. I mean, you're putting them all over the country.
Facilities we built with automation so that not only does it help productivity, which is where people typically certainly go with that. It's other KPIs like quality. Our quality is much better. Our throughput is much better. And even safety. Our worker safety is better because there's fewer people and equipment moving around. The products are coming to them. So that's 3 out of the 11. We have plans. We already made commitments for 3 additional new DCs. So we're going to be the best at the underlying core of that business. And then with our ADS acquisition just this last year, we're also making strides with the commercial side. We were best of the best in operations. ADS was best and the best in the commercial and the patient acquisition, the patient relationship. Bringing those two businesses together has created a lot of synergy, a lot of value, but also a lot of better service for patients.
All right, so multi-year, is diabetes one of many? Are there more coming? Verticals that people should look for?
Yeah, so diabetes is just one area of our business within at-home solutions. I think about any type of medical supply, chronic diseases when you need supplies in the home. A lot of, whether it's urology is one area where we're the biggest in urology within the space. Ostomy, nutrition, those types of products that require replenishment of supplies is what we are best at and what we're going to stay focused on.
I don't know if people understand the moat. You don't want to go against Holler. You don't want to go against Cardinal.
You do not want to go against my team, and that's because we are going to stay focused on the core of the operations, do it better than anyone, so that we then earn the right to do some of the higher value add activities and services on top of that.
Is the president going about a good way or a bad way to be able to lower costs of the system?
Well, we love access and we love innovation and we love the affordability. These are all things that, at the end of the day, volume is an important aspect to our success. When you think about the utilization, the aging America, the demographics, the innovation, these are all things that drive up unit costs in pharmaceutical as well as other products. Without that volume, it's hard for us to invest into our core of operations to justify that type of payback. So we have a lot of confidence that volume is going to be there because we have a lot of confidence affordability will be focused on so that Americans will get access to the medications and the other medical products that they need.
I don't want to slag the people who were there before you because they did a good job at Cardinal. But this is not Cardinal. Sometimes I think you should change the name. I'm not kidding. Because what you've done is become integral to the healthcare system, drive down costs, not friction. And it's almost, this is just nothing to do with the Cardinal of even 10 years ago.
Well, we're really proud of the operational improvements we put in, the progress in the strategy. The one thing that has not changed in this enterprise since the beginning 54 years ago is the culture and the values of the company. That has been steadfast and is the strong foundation that we are continuing to build upon.
Is that how you're just continually able to beat the numbers? $10? I mean, this is rather extraordinary what you've been able to do.
Yeah, the earnings update that we gave today to be able to achieve at least $10 EPS for fiscal 26, we're proud of that. It's a reflection of both the underlying volume and utilization marketplace remains quite robust, but we're translating that into pretty good operating results because of our focus on the operations and the core there, as well as the investments that we've made in specialty. Those are paying off. One of the announcements today is that we now expect specialty to be about $50 billion in fiscal 26, so that's a business that's growing at a 16% CAGR. So we've got a $50 billion business growing at a 16% CAGR, and it brings around with it some other nice value-add services. It's a good business to be in.
Well, I want to congratulate you. When you came on the show, I was skeptical because I knew that you were a middleman, and that is certainly nothing to do with what you do
as you know, Jim, and we talked before, we're the beginning, the middle, and the end of the healthcare industry. We are the backbone of the industry, and that's why we are confident that we'll continue to provide a lot of value for
and that's why the stock keeps going higher. You have a real ethos. I want to congratulate you. Jason Holler is the CEO of Cardinal Health. And by the way, hey, listen, much better than expected earnings. Can't beat that.
Yep, thank you.
I like to say there's always a bull market somewhere, and I promise I'm just for you right here on Mad Money. I'm Jim Cramer. So long from San Francisco. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.